Since reform and opening, China's financial sector has achieved remarkable milestones. It has become a primary engine of economic growth, a market leader with diverse services, and a field with increasingly robust legal frameworks and advanced technologies with modernized management models. Yet, serious issues persist, including neglect of integrity, materialism over human values, profit over ethics, and legality over morality. Key manifestations include: first, neglect of integrity. Financial institutions are, at their core, credit institutions. Credit inherently demands unwavering integrity, repaying principal and interest on time, and honoring commitments. Without trust, banks cannot conduct remittances or grow. Integrity is the foundation of finance. As economist Zhang Weiying observed, honesty is the best competitive strategy in the market. Integrity and trust are the keys to victory in competition. However, many financial practitioners fail to recognize the importance of integrity. They do not understand that credit is the foundation of finance and the lifeline of a company's long-term development. Under the mindset of scale above all, some institutions will stop at nothing to expand market share, aiming for short-term gains without considering long-term trust. One example: today's market is flooded with various bank cards, debit, credit, etc., which do offer convenience but also carry hidden risks. Many consumers have discovered unexplained deductions from their accounts. Regardless of whether the charges are legitimate or not, when customers initially receive these cards, bank staff often highlight the benefits while omitting details about fees. Later, when users realize they've been charged, they feel deceived, reducing their trust in the bank. The result? The next time the customer needs banking services, they're unlikely to return to that institution. Therefore, upholding integrity is the foundation for a sustainable market presence. Second, prioritizing material over people. Shanxi draft banks place more value on personnel credit rather on material guarantees. Loans were primarily based on a borrower's reputation, no collateral required. In contrast, modern banks rely heavily on secured loans, demanding sufficient collateral and multiple evaluations before dispersing funds. The shift from trust in people to trust in things is partly due to modern society's lack of interpersonal trust. In today's market economy, however, the idea of valuing people over material remains crucial. People are the drivers of productivity. The people-oriented philosophy urges financial institutions to respect employees and clients alike. While seeking profits, they must also protect employees' and clients' interests, offering platforms for talent development and sincere services to build mutual benefit. Third, pursuit of profit over ethics. In pursuit of profit, some institutions and practitioners cut corners and show poor awareness of compliance. From a corporate perspective, banks often focus excessively on immediate returns, channeling funds into concentrated sectors while ignoring long-term risks. Big clients are prioritized while vulnerable groups are neglected. Some even engage in gift-giving and wining and dining to win business, rather than innovating services that meet genuine market needs, especially in rural areas. Social responsibility is often overlooked. From embezzlement and falsified documents to outright fraud, violations persist due to distorted values and weak professional ethics. When money becomes the sole belief system, social-moral crises follow. Economic crises may pass, but a trust crisis is the most dangerous of all. As the saying goes, a gentleman loves wealth but gains it righteously. Enterprises must value justice before profit. Without moral restraint, society is on the edge of collapse. Fourth, culture of rapid growth and blind expansion. Modern financial institutions have grown rapidly, but this has fueled unhealthy competition. Banks chase size, believing higher deposits equal victory. As a result, many pursue volume over quality, cutting corners in customer service and employee treatment. Instead of fostering growth through improved service and professionalism, they rely on aggressive recruitment and client acquisition. In some joint stock banks, employees face immense pressure, having to meet monthly deposit quotas in the millions. Failure means risk of unemployment. If banks operated like Shanxi draft banks, rooted in honesty and service, employees wouldn't need to bear such burdens and customers would flock to them naturally. There is a multitude of problems plaguing financial culture and the financial industry as a whole today. Tune in for the last and final episode to learn about recommendations and potential solutions. And as always, don't forget to like and subscribe.